One of the most overlooked parts of investing in crypto, especially during a bull market, is taxes. Nobody wants to talk about them, but not thinking about taxes until it's too late can completely ruin the excitement of taking profits. You spend months, even years, building your portfolio. You finally hit those numbers you've been dreaming about. You start taking profits, and then, surprise, you get hit with a massive tax bill you weren't expecting. Well, it doesn't have to be that way. You just need to understand how it works before you start cashing out. So, in today's video, I'm going to walk you through what crypto taxes actually look like, what events are taxable, how to avoid the biggest mistakes, and what you can do right now to minimize your tax burden legally and responsibly. So let's start with the basics. In most countries, including the US, crypto is treated as property for tax purposes. That means it's subject to capital gains tax when you sell it, trade it, or even use it to buy something. Here are the most common actions that count as taxable events. If you sell your Bitcoin or any crypto for fiat, like cashing out into USD or euros, that's a taxable event. If you trade one crypto for another, even if you never touch fiat, that could be a taxable event depending on your jurisdiction. So swapping Ethereum for Solana or Bitcoin for USDC, that could trigger capital gains. If you use crypto to buy goods or services, like paying for a flight or buying a laptop with your crypto, that also is a taxable event too. If you receive crypto as income, whether it's from staking, mining, freelancing, or participating in an airdrop, that's also treated as ordinary income and taxed based on the fair market value at the time you received it. Even NFTs could be included. If you sell an NFT or trade one NFT for another, or received one in an airdrop, that can also be taxable, again, depending on the jurisdiction that you're in. And keep in mind, this isn't just about what happens on centralized exchanges. Technically, everything on chain counts too. It's all traceable. So if you've been active in DeFi, providing liquidity, earning yield, flipping tokens, it's worth going back and documenting every move. Now let's talk about capital gains, short-term versus long-term. If you sell your crypto within 1 year of buying it, it's considered short-term capital gains. These are usually taxed at your ordinary income tax rate, which can be as high as 37% in the US, depending on your income bracket. If you hold your crypto for more than 1 year before selling, you get long-term capital gains treatment, which is taxed at a lower rate, generally 0%, 15%, or 20%, depending on your income level. In Portugal, for example, holding crypto for 1 year or longer grants it tax-free. So timing matters. And planning matters even more. A lot of people take profits during a bull market without realizing they're triggering short-term gains. They figure they'll worry about it later, but when tax season rolls around and they've already spent that money or reinvested it, they end up scrambling to cover a tax bill they didn't prepare for. Another mistake is thinking that moving coins from one wallet to another is taxable. It's not. As long as you're not trading or selling, simply transferring your coins to a different wallet you own is not a taxable event. But it's still a good idea to track those transfers so you have a clean record. So, how do you track all of this activity? The best way is to use a crypto tax tracking tool like Coinly, CoinTracker, or Accounting. These platforms let you connect your wallets and exchange accounts, and they automatically calculate your capital gains, income, and losses. They're especially helpful if you've been active in DeFi or if you've used multiple blockchains. It's still a good idea to double check the output. And if your portfolio is large or your activity is complex, I highly recommend working with a crypto-savvy accountant or tax professional. Now let's talk about the good part, how to reduce your tax bill legally. One of the smartest strategies is called tax loss harvesting. This is when you sell assets that are down from your purchase price, locking in a capital loss that can be used to offset your future gains from other crypto sales. So let's say you made a $10,000 gain selling Ethereum, but you're holding a smaller altcoin that's down $6,000. If you sell that altcoin, you can offset part of your gain, so you're only taxed on $4,000 instead of a $10,000 gain. You can also use the strategy at the end of the year, even during a bull market. Most jurisdictions allow you to deduct a certain amount of losses from your taxable income. And in the US, you can carry losses forward into future tax years if needed. Another tip is to be strategic about when you sell. If you're approaching the 1-year mark on a big position, waiting just a little longer could mean the difference between paying short-term versus long-term rates. That might not always make sense, but it's worth considering if you have a significant amount at stake. Now let's talk about something that's becoming more and more relevant for a lot of people in crypto, and that's relocating to a more favorable tax jurisdiction. Speaking from experience, this is amazing. Now, the idea of moving to a crypto-friendly country isn't just a fantasy. For people with significant gains, or those planning to build their lives around this crypto space, it can be a smart move. But it's also a serious decision that comes with legal, financial, and lifestyle considerations. Let's start with Portugal. Now, for years, Portugal has been one of the most talked about destinations for crypto holders because of its zero tax on capital gains from personal crypto sales if you've been holding for at least 1 year. That means if you're a resident and you're selling your own crypto, not as part of a business, you don't owe capital gains tax. Also, it's important to note, as of 2023 in Portugal, crypto held for less than 1 year is subject to a 28% tax. But like I said, long-term holders still benefit from a tax-free status. Portugal also doesn't require crypto-to-crypto reporting, which reduces the compliance burden on everyday users. Germany is another strong example. If you hold your crypto for more than 1 year, your gains are completely tax-free when you sell. This includes swapping between cryptocurrencies and even spending crypto, provided the holding period of 1 year is met. Short-term trades are taxed as income, but for long-term investors, Germany's policy is incredibly generous. And just like with Portugal, Germany also differentiates between personal investing and business activities. So if you're running a crypto-based company or trading full-time, you'll fall under different rules. Then there's El Salvador, which made history by adopting Bitcoin as legal tender, but Bitcoin only. The government has stated that foreign investors are exempt from capital gains taxes on Bitcoin, and there's no tax on income generated from Bitcoin appreciation. While practical infrastructure and clarity are still developing, El Salvador has positioned itself as a crypto haven for people who want to build and spend in a Bitcoin native economy. The IMF hates it. Moving to one of these countries doesn't automatically make your tax problems disappear. You need to understand how your current country of residence treats foreign income and capital gains. For example, if you're a US citizen, the IRS will continue to tax your global income no matter where you live unless you formally renounce your citizenship. So again, this is where a qualified tax professional becomes incredibly valuable. But if you're not tied to a particular location and you're serious about maximizing your crypto gains, relocation is something worth exploring. Just be sure to do your homework. Look at not only the crypto tax laws, but also the quality of life, the legal system, the local economy, and whether that jurisdiction aligns with your values and lifestyle. I highly recommend first traveling to these locations and see how it feels in real life versus just how it looks on paper. Now, I'm not a tax advisor, so I'm not here to give you personalized advice, but I can tell you that crypto taxes are not something you want to deal with after the fact. You'll save yourself a lot of stress and potentially a lot of money by having a plan before you start selling. If you've made life-changing gains during this bull market, first of all, congratulations. That is a huge accomplishment. But now it's time to make sure you keep those gains and protect yourself from unnecessary setbacks. or extortion. So, to recap, understand what actions are taxable before you make them. Track everything, every trade, every wallet, every airdrop. Use tools like Coinly or Coin Tracker to stay organized. Learn about tax loss harvesting and timing your sales. And talk to a professional if you're unsure, especially if you've had a big year. Let me know in the comments, how are you planning for taxes this cycle? Do you live in a crypto tax-friendly jurisdiction, and how much are you enjoying that? Have you used a crypto tax tool before, or are you thinking about working with a pro this year? If you have used a crypto tax tool and you had a good or bad experience, please share. And if you want to learn more about navigating crypto like a seasoned investor, from security and market cycles to smart tax planning, check out learningcrypto.com. We've got real strategies for real people. No hype, just practical help. Thanks for watching. I'll see you in the next video.